Thanks very much for that warm introduction. It's a pleasure to be here. I want to make one small correction to what Len said about that little prediction or projection in 2008. It was $90, and it was $90 based on what I thought were relatively objective criteria for thinking about the fair market value of oil. And I still think about those objective criteria, and I want to get to that later, but those criteria that we used in 2008 to think about where fair market value ought to be really did point to around $90 a barrel for average crude prices. That's a complicated subject of what do you mean by average. And today I would say we're looking at a lower number. The price of oil has been trading within a very specific range since the Libyan disruption in February of 2011. It's been trading, if you look at Brent, between $90 and $120. It actually has averaged by quarter about $110 every quarter since the first quarter of 2011. We are projecting lower prices this year by about $10 a barrel, maybe a little bit higher than that, and it looks to us as though average prices will be trading in a range that's significantly lower than the $90 to $120 barrel range, a range of 70 to 90, and I'll happily talk about why that's the case. But speaking of that, when it comes to the geopolitics of energy and the geopolitics of oil in particular, but I'll be talking about oil and gas a bit, there aren't always winners and losers. There is no real equilibrium in which everyone benefits when it comes to the nature of the energy industry. And that's largely because of the structure of the business, not only between upstream and downstream, but the structure of business between producing country governments and consumers not organized by governments around the world. We've just ended a decade in which, as Len said, oil prices jumped significantly in nominal terms. The last decade began with oil averaging about where it has averaged for the previous 20 years, around $20 a barrel, and the decade saw prices, as Len said, going to 147, 48 before falling again and averaging close to or above double digits since 2009. There is nothing that cures high prices like high prices, and high prices are the key to it because high prices stimulate capital expenditure, and capital expenditure stimulates new supply, and it also stimulates technological change. And during the last decade, there were technological changes that enabled producers in the world to tap into resources that had never previously been available to tap into. North America happens to be abundant in all three of the new reality of oil markets. North America, whether it's Canada, Mexico, or the United States, is unbelievably well endowed when it comes to oil sands. It's unbelievably well endowed when it comes to shale and tight oil, and it's incredibly well endowed when it comes to the deep water. None of those sources of supply could have been exploited to the degree they've been exploited had it not been for high prices. And naturally, when you have new sources of supply, it changes the geopolitics of a sector that is rife with geopolitics, a sector that's been rife with geopolitics really since the so-called Yom Kippur War of 40 years and some 4 months ago, a war which led to an Arab oil embargo, led to a massive use of oil as an instrument of international policy by a bunch of Arab oil producing countries. It produced petrostates that are riddling the environment today, and it produced reactions, including reactions in Canada, which joined the bandwagon of resource nationalism, and in the United States, which acted in a tit-for-tat manner to counter a boycott, to try to set up mechanisms that would never allow a boycott to emerge again. Let me talk about the high prices for a bit, because the high prices that we saw did trigger this incredible supply revolution in Canada and the United States, which have for the last 5 years been the two fastest growing hydrocarbon producing countries in the world, starting with Canada, but then overtaken by the United States. In the U.S., oil situation is nothing but phenomenal. It is awesome. It is mind-boggling in its implications, because unlike what's happened in Canada, where a very difficult, high-cost resource has been developed in the oil sands, in the United States, a relatively low-cost oil resource has been exploited, and it's a resource that happens to be everywhere. It happens to be everywhere where there are source rocks filled with hydrocarbons, and there's a bit of it in Canada, there's a lot of it in the United States, there's an incredibly large amount of it when it comes to natural gas in Mexico, yet to be exploited, but it's in Russia, it's in Saudi Arabia, it's in China, it's in Brazil, it's in Argentina, it's in Morocco, in Algeria, it's in Jordan, and it's going to be just a matter of time before that resource base globally gets exploited, which is one of the reasons that we're looking to lower prices ahead. The U.S. has increased its production in the last 5 years by an amount that's more or less equal to the total production of Canada. The increase is over 1 million barrels a day. It's been, if you add in natural gas liquids, about 1,300,000 barrels a day, and the production base is actually accelerating in terms of its rate of growth. One of the reasons oil has traded in this range between $90 and $120 a barrel is because of what's happened in North America and with North American supply. One of the reasons prices have been elevated is because, starting with the so-called Mena Spring, we've seen the denouement, the ultimate denouement of Petrostates occurring. It's a rebellion of the governed looking for the voice of the people, the vox populi, against governments that looked in their eyes to be illegitimate, and where governments that have control over resources are providing an enticing target for groups to get part of the grab, to get part of the resource base. So we're seeing disruptions, and we saw a massive disruption in Libya in February 2011. It led to the exit of 1.5 million barrels a day of light sweet crude, 10% of the light sweet crude produced in the world. Since then, the U.S. has increased production of light sweet crude by 2.5 million barrels a day. The problem, and it is a problem, and it's a problem I'll focus on, is that the U.S., when it comes to energy policy, has a dysfunctional government, and the only government that may be more dysfunctional than Washington is the government in Ottawa when it comes to energy policy. So these two giants of the last 5 years when it comes to energy supply have incredibly dysfunctional politics when it comes to rationally managing the resource base and managing relations with one another at the same time. But the fact that the U.S. increased production during this period of time is incredible. In Libya, the issue is who gets the rents. The central government, post-Gaddafi, wants the rents. Provinces, and in particular the eastern area of the country, wants the rents. The oil company wants the rents. The workers want the rents. We're seeing the same kind of situation unfolding in Iraq, where the government wants the rents, the regions want the rents, the cities want the rents in a relatively corrupt environment. We're seeing similar issues unfolding in a different way, but certainly Nigeria, where we've seen disruptions unfolding, not quite at the level perhaps of Libya, not quite at the level of problematic development of Iraq, but pretty problematic. And I suggest that we will see something similar emerging in Venezuela before too long. So we're seeing the results of the Petrostates unfolding, and it may spread beyond the countries that I've mentioned, countries that since the Libyan Spring need to find ways of raising revenue. They are particularly dependent on oil and gas revenue, and they are particularly dependent as they try to buy off their publics in an environment in which publics want to participate in the rents. They are particularly vulnerable to the oil price. So we have in Iran today a country whose so-called fiscal break-even point, if the government wants to keep its budget neutral, is $140 a barrel. We have in Venezuela a fiscal break-even of about $160 a barrel, in Yemen $280 a barrel, in Russia $120 a barrel, in Saudi Arabia somewhere between $80 and $90 a barrel. With lower oil prices ahead, there are clear winners and losers, and there will be more governments that will be vulnerable to the kinds of events that are unfolding in Libya and unfolding in Iraq. Let me talk for a minute about the old geopolitics of energy, the geopolitics of energy that we tend to be more familiar with, the geopolitics of energy that emerged starting with the Yom Kippur War in a 7-year period of time when governments in oil-producing countries seized the banner of resource nationalism, including the Canadian government, not to the degree of other governments, but nationalizing the oil industry. The shift in wealth from oil-producing companies to oil-producing countries was quite dramatic with the nationalization of about 80% of the world's oil production in the period 1973 to 1980. It's a period in which those who controlled oil didn't want markets to work. Markets were the enemy. And let me suggest ways in which this happened, because we moved very quickly from a world of $2 oil to a world of $18 oil, then a world of $30 oil, before things came back to reality. We normally think of markets functioning so that the lowest cost production is in the market first, the highest cost production is in the market at the margin when prices go up. But the oil producers changed that after 1973 by controlling exports and putting the economics of this commodity on its head by having the lowest cost producers shutting in production in order to increase the delta, the rent that they were able to get between very low cost production and very high cost production. So that world was not able to unfold as it had before, where you get low cost production through technological change and competition. But ultimately, this new technological revolution that's unfolding, particularly in shale and in deep water, is going to change that. And just on a word on that, the U.S. has a resource base in deep water and in shales. Canada has essentially a resource base, so far mostly in oil sands. If we were to map up a cost curve of oil in the world, the price at which you need oil to be traded, to have an investment pay back an investor and be profitable. Canada, unfortunately, sits at the very top of the curve. So virtually all Canadian oil sands projects require somewhere between an $85 and $100 oil price to trigger CapEx. You can continue production in the oil sands because operating costs are extremely low in comparison to projectable oil prices. But the capital machine, the capital expenditure machine, would dry up at significantly lower prices. In the U.S., it won't dry up because technological change is driving prices down at the rate of efficiency gains of about 25% per year. Those efficiency gains are nowhere ending in any reasonable sight. The U.S. also engaged in anti-market behavior, and there's a lot of talk now where there's an export debate in the United States about suing the U.S. in the WTO for not allowing exports or allowing them only partially. Canada actually is the only country in the world where oil can be exported from the U.S. on a sustainable basis. U.S. oil exports to Canada are growing. They doubled last year from around 65,000 barrels a day to 130,000 barrels a day. They will increase probably this year by more than doubling from 130,000 barrels a day with which the year started to probably 300,000 barrels a day by the end of the year, because it's the only outlet at the moment for U.S. surplus production. The U.S. joined the fray too. The U.S. put on export bans in 1974. The reason was really quite simple. Before 1970, the U.S. was a protectionist country when it came to oil. The U.S. had the largest amount of surplus production capacity in the world. It was very high-cost production. So in the interests of oil producers in the U.S. Put on quotas in 1958. As a result of that system of quotas, U.S. prices were double world oil prices from 1958 until roughly the time of the Arab oil embargo. The Arab oil embargo reversed that, changed it so that global prices were double U.S. prices. Now, why didn't U.S. prices rise? Very simply because in 1971, when the U.S. forced the devaluation of the dollar, the U.S. put on price controls, oil at the wellhead, oil at the burner tip, natural gas at the wellhead, natural gas at the burner tip. Other things also had price controls, but when oil prices doubled and the U.S. permitted oil exports, there were lines at gas stations because there was a problem with the underlying oil supply. And the way the U.S. government fixed that was to ban the export of oil so that U.S. prices could stay well below world prices. There are two other elements of the geopolitics of energy which I'm going to throw into the pool that are unfolding. We have the old guard trying to hold on to the OPEC way of doing things. We have this challenge to that order coming out of North America, essentially, at the moment. And there are two other big players in the international oil and gas markets. There's, other than Saudi Arabia, which I take it as a code word for OPEC, the U.S., Canada. The other two are China and Russia. The European Union has basically opted out of the game. Russia has been essentially a very lumpy but huge supplier of hydrocarbons to Europe, and what's unfolding in Russia is a movement to not be just a lumpy European supplier, but to be a global supplier, and to find ways to exercise influence globally through global supply patterns. It's a government having a very difficult time doing it because it's hard when you're not the biggest player in the business to be anything other than a price taker. It's hard when you rely on revenue as a government from oil and gas exports to manage a system rationally. And it's particularly hard when, as a result of resource nationalism in Russia, the largest company in the world now is Rosneft. Rosneft is incredibly indebted, and the way Rosneft is dealing with the debt on its balance sheet is by allowing China to buy it out of trouble. But in the process, it's putting Rosneft in hock to Chinese entities for the next 20 years. So Russia will effectively be selling its oil more globally than to Europe, but it will be stuck with a couple of partners on the buying end who will have as much influence on the price and manner in which they sell or more influence than the Russian government will have. And of course then there's China, which is the other lumpy player in this business. China has essentially bought Central Asia or stolen it from the former Soviet Union. It has preempted all of the supplies that Russia used to control in Turkmenistan, Uzbekistan, Kazakhstan, very rich sources of oil and natural gas. And I left out Tajikistan and Azerbaijan, which are by no means inconsequential. Azerbaijan is a bit more independent, but it tells you where China is going, which is to tie in resources by pipeline from neighboring countries. 60% of the natural gas that China imports comes from Central Asia. Chinese don't like to be dependent upon sea lanes in an environment in which they know the U.S. controls sea lanes, and where China will have a very difficult time building up a naval security apparatus that compares with that of the U.S. I'm happy to go back to China and Russia when we get into discussion. I want to talk a bit about the U.S. and Canada and the dysfunctionality in multiple ways of both of these governments, which are kind of wetted at the hip when it comes to an integrated energy market. Both countries are well endowed in oil. They're both also well endowed in natural gas. They are extremely well endowed in natural gas in the market that binds them, which is a market in which Canada exports natural gas to the United States, about half as much as was exported at the peak, and it's about half as much because as the U.S. production base has grown, it's pushed back natural gas that formerly came out of Alberta, essentially, into the U.S. mid-continent. The U.S. exports natural gas to Mexico. At its peak, the Canadian supplies in the U.S. were roughly 10 billion cubic feet per day. That's equivalent to just under 80 million tons per year. To put that in perspective, the 80 million tons per year that Canada at its peak exported to the U.S. is smaller than the amount of natural gas that Russia supplies to Europe, but larger than the amount of natural gas that Qatar supplies to the world through LNG. So Canada has been essentially the second largest exporter of natural gas in the world. The U.S. now exports about 2 BCF a day to Mexico. The U.S. companies and some Canadian companies are currently building new pipelines from the U.S. to Mexico, which will have a capacity by 2018 to export 9 BCF a day from the U.S. to Mexico by way of pipeline, which will exceed probably Canadian flows into the U.S. Unless there's a trigger for more Canadian flows to come into the U.S., and there may well be a trigger. Both in the U.S. and Canada, there's stranded natural gas. The U.S. is currently the largest gas-producing country in the world. In terms of wet gas, the U.S. produces now 72.5 billion cubic feet per day, larger than Russia. The U.S. production base is capable on a sustainable basis of producing 100 BCF per day. Most of that increment is likely to go into the export market. Some of it will go to Mexico, as I just indicated. Some of it should go to Canada, and the U.S. is already displacing Alberta as a supplier of natural gas to eastern Canada. I imagine the order of magnitude by 2018 will be 2 BCF a day to eastern Canada. And the U.S. has begun the process that Canada has not yet begun of approving and starting up LNG projects. The U.S. has so far approved close to 8 BCF a day of exports of LNG. The exports start in 2015. By 2018, the U.S. should surpass Qatar as the largest LNG exporter in the world. The dysfunctionality of politics at the national provincial and local level in Canada has made it impossible to actually start the construction of a single LNG project. And Canada is not the only country that has a surplus of gas. As I said, the U.S. has no foreseeable impediments to the export of natural gas, unlike the impediments to export oil. The other places that are seeing surges in LNG projects include Australia, which is extremely high-cost LNG. Canada has the benefit of being a relatively low-cost participant in the LNG business, probably the lowest cost next to Qatar, if that production could get into the process of pipelining it to the West Coast, liquefying it, and shipping it to global markets. With new discoveries in East Africa, also relatively low cost. The danger is that production from British Columbia will be frozen out of the LNG business unless decisions are taken very soon. Ironically, the U.S. is effectively going to be exporting Canadian gas, but it's U.S. LNG production that will be doing it. The way we look at the North American gas balances, in order to put a lid on prices in the U.S., as the U.S. starts to export LNG, it will, despite its very large production base, divert a lot of natural gas from the mid-continent, where U.S. natural gas has displaced Canadian gas. So by 2018, when we see meaningful numbers, we think that Alberta natural gas will fill in the gap when it comes to Chicago and other cities in the U.S. that are currently being supplied by production in Texas and Oklahoma and Louisiana. So there will be less profitability for the Canadian producers, but that production will come as the U.S. producers enjoy the higher prices. The LNG market is a market that is about to be revolutionized, whether Canadian producers or production by non-Canadian owners of LNG plants get into the market. The problem on the Canadian side, despite the issues related to politics on pipeline construction and liquefaction plant construction, really relate to the mindset of the planners of the LNG projects, which are hoping to base those projects on an oil link. So when it comes to the LNG markets of the world, one of the artifacts of the 1970s is that natural gas traded in the world through LNG is traded on an oil-linked basis rather than on an AECO basis or a Henry Hub basis. In North America, we tend to price on gas competition. The LNG market globally has been based on producing a number which comes out of what's called the JCC, in common parlance, the Japanese crude cocktail, but in actuality, the Japanese average custom clearing price for, on a monthly weighted average basis of all crude oil imported into Japan. That's the marker. For LNG, that's the marker that's being aimed at by the LNG exporters of potential ones out of BC. All of the U.S. exports are based on Henry Hub prices, and the incremental buyers of LNG would like to see pricing move away from an oil link and onto some other price link. And yes, it is true that Henry Hub gas was selling at $5.70 yesterday morning. And yes, it is true that this is a mild winter in Asia, and spot gas is selling in a way that would not allow a lot of U.S. gas to move to Asia. But this is a temporary blip in natural gas pricing. It's one which will be alleviated significantly in the months to come. There are a whole bunch of things that are going to happen when the U.S. starts exporting LNG on a Henry Hub basis in a meaningful way. And think about the supply from Australia or Canada, should it come, or the United States. And think about being a buyer of LNG and having two things happen. One, having supply in large quantities that's on the outside of the Strait of Hormuz rather than the inside of the Strait of Hormuz when it comes to security of supply. And then think about what's happening when you can get this on a Henry Hub basis rather than on a crude oil linked basis. So we think there's going to be a sort of revolutionary change in the global gas market, which will bring prices down, which will deprive the LNG producers, current or potential, who want an oil link price for getting that. Let me turn to some other issues and talk about pipelines and production. Since 2007, the rate of production growth in North America has exceeded the pipeline takeaway capacity. When Canadian production started growing on a prorated, remarkable way, on average 200,000 barrels a day per year, and you get 5 years and you get 1 million barrels a day, and you get 10 years and you get 2 million barrels a day. That Canadian gas was trapped. It wanted to get into the U.S. market, and the U.S. market was basically a very large roach motel. It was an area where you could get in, but you couldn't get out. And the mindset in 2007 was that the U.S. production base was declining, and U.S. consumption was growing. And the reality of the world today is the U.S. production base has already grown by 60% and has continued to grow at an even faster rate, and U.S. consumption has declined. So the nature of the market has shifted, and to think about where Canadian oil ought to go, it ought to go into the Pacific Basin to get the highest netback to the wellhead in Alberta. Politics of getting it to the West Coast are very difficult, whether it's by pipeline or rail, and it can get to the West Coast either by pipeline or rail. There recently has been some oil sands production exported to Asia out of the Canadian West Coast, since there is an available pipeline system, but the current capacity is by no means robust, let alone robust enough to take up that capacity. The other choices are going east, and there are plans, of course, to convert the main line into a massive export facility with a potential capacity of close to 800,000 barrels a day. That would be great. The only problem is the Atlantic Basin needs no supply from Western Canada. It's the wrong market for the wrong kind of crude, and it would get there at a delivered price, which would be around $9 a barrel on the pipeline transportation. The same would be the pipeline transportation costs to the U.S. Gulf Coast. We're seeing in the U.S. part of North America also trapped oil in the mid-continent now that the state of North Dakota has in the last 4 years gone from producing no oil to producing 1 million barrels a day, becoming the second largest producing state in the United States. And we've seen production in Texas grow by 1.5 million barrels a day during the same period of time. But the oil produced partly in Texas, partly north of Oklahoma, also can't get out by pipelines, which, as they're built in a massive way in terms of miles or in terms of capacity, are still being outstripped by the growth in production. We're going to see a bit of a change in this, by the way, this year. A change in it because this is a year in which there's 2.5 million barrels a day of new pipeline capacity being built in North America. That will, by the end of the year, bring about a big change. Instead of Canadian crude getting to the U.S. Gulf Coast, where there is a market to process it, there will be about 800,000 barrels a day more capacity to bring Canadian crude to the U.S. Gulf Coast at the end of 2014 than at the beginning of 2014 through a series of pipeline connections, the first of which has just opened. It's the southern link on Keystone XL from Cushing in Oklahoma to the U.S. Gulf Coast. That pipeline has some 700,000 barrels a day of capacity. Of course, the flow in it is not that. The initial flows have been light sweet crude rather than Canadian crude, but there will be Canadian crude coming in. That and other pipeline fixes should create an equilibrium point for Canadian crude, and I'll talk about the equilibrium point in a minute. Even if Keystone XL is not built, the hope for rail is now being dashed a bit by the rail infrastructure problems and the accidents that have hit newspaper headlines in both Canada and the United States. In one case because a small town was wiped out, in another case because a lot more people were killed, but a town was not wiped out. So we're seeing both on a bilateral basis and internal to both countries a significant increase in regulatory oversight on the rail system with improvements in mind which will, so to speak, derail the rate of growth of use of rail for transportation. To wrap your hands around the number is also kind of incredible. 5 years ago, virtually no oil was moved by rail in North America. Today, between the two countries, 1,700,000 barrels a day is moved by rail, sort of going back to the 1890s, when pipelines could be, should be put in place, but aren't being put in place. Canadian crude is going to reach the U.S. Gulf Coast this year. This will bridge some of the gap. The U.S. Gulf Coast is turning out not to be the best place to plant Canadian crude. It's going to be a good place for a while because stranded in the mid-continent, we've had two phenomena. One is WTI, the U.S. benchmark that looks like, smells like, and trades, if it could trade, like Brent, was trading last year at a $27 discount to Brent, is trading today at a $12 or $11 discount to Brent. WCS has been trading at a $20 discount or a $30 discount to WTI. With pipelines, WCS and other Canadian crudes will be competitive in the U.S. Gulf Coast market. But the U.S. Gulf Coast market is really, truly problematic. It is problematic because there are other producers of similar crude, one of which is called U.S. production from the deep water. U.S. production from the deep water is sour crude of a gravity similar to a lot of Canadian crudes. U.S. Gulf of Mexico production happens to be growing on an accelerated basis, and U.S. production can't be, by law, exported. So it's certainly going to be absorbed in the U.S. Gulf Coast market. Saudi Arabia has 1,200,000 barrels a day of refineries that it owns in the U.S. Gulf Coast. If you are Saudi Aramco and you are trying to sell 8 million barrels a day of oil, even though that oil currently gets you $20 a barrel less than selling the same oil to China, you don't want to move it away from the U.S. Gulf Coast because you don't want to put all your 8 million barrels a day of exports into the same region or all of it into the same country. So you want to preserve that market, and that will continue to depress prices. And then there's also Venezuela and Mexico. There is a way out. In theory, at least, Canadian crude that enters the U.S. in Montana or Idaho or somewhere else can exit the U.S. In Louisiana and Texas. It's easier to do this if it's railed. So there has been Canadian railed crude to the U.S. East Coast that has been exported to third-party markets, not in large quantities, but at least giving a hint that this can be a mechanism. In theory, as I said, you can re-export out of the U.S., but because of the commingling of molecules, it's been very difficult to get the regulators in the U.S. to agree to a regulatory regime to allow Canadian crude to be exported. But in theory, at least, the amount of pipeline capacity should work until 2015 or 2016, which is not as far away as it was in 2013. And Keystone XL is really needed by then. And if it's not done by then the solution will be rail, or the second best of using the main line, or maybe there will be authorization, finally, of pipeline construction to the West Coast. Well, I've rambled on. I've hit a bunch of rich topics, I think, and I'm really happy to engage in a dialogue with you for the remaining time. Thanks very much. Should I recognize the questions, or should someone else?
Sure, why don't you?
Yeah, there's a question in the back, and I don't know whether you need a mic or not, but if you don't.
Okay, you just talked indirectly about Keystone XL, and now it's been at least a handful of years in the discussion stage. What's going to be the final solution? Why is it taking so long? What do you think will happen? I know you don't live in Washington.
My wife thinks I live in Washington, but that's a different issue. No, I spent a lot of time in Washington, and I don't think I understand fully what the decision will be. But clearly the veto that was enacted by the president in January 2012, the beginning of a presidential election campaign, was based on presidential election year politics. At the time, was a decision not made by the president being fully briefed by White House officials, but rather the White House officials who dealt with this matter were taken by surprise because the decision was made by the president, but it came out of Chicago and it came out of his campaign staffing rather than by the staffing in the White House. So it was a presidential decision based on election year politics. The main issue at stake at the time was the largest underground reservoir in the United States in a agricultural area where the environmental groups played a major role in stirring up the agricultural sector, and where I would say the Canadian company involved, and I recognize this is being videoed, and I work in a regulated sector of the U.S. economy, and I'm actually not allowed to talk about companies, so I'm not going to mention the name of a company that everybody knows what it is, but I would say that from a domestic U.S. perspective, when confronted by the environmentalists stirring up the farmers, they did not behave as wisely and proactively as they might have. So that was also a problem. The other problem was that the president not only was a recipient of significant amount of campaign contributions from those environmental groups, all three of the main ones, but he was very close personal friends with the leadership of two of them, and he had been campaigning as an environmental, proactive environmental integrity person who cares a lot about climate change. It was expected that there would be a new environmental impact statement only dealing with the spur line that was going to be built around the underground reservoir. Everybody knows that modern pipelines that are done not by welding steel but by seamless construction and wrapping that seamless pipe in concrete is significantly safer than the very large number of pipelines already going through that reservoir that are 70 or 80 years old. But that was not part of the consideration. There have been delays since then. Those delays have prevented the State Department from issuing a final environmental impact statement. It now appears that the environmental impact statement will be broader than just that spur line in the state of Nebraska, and it will trigger a 4-month process, after which, at least on paper, the President will have to make a decision. It is not clear to people who put odds on this what the decision will be. The President is going to make a State of the Union speech imminently. It is expected to be a speech that is focused on an environmental legacy. He has brought back into the White House somebody who was in the White House under President Clinton, who is an opponent of Keystone XL. He wants to leave an environmental legacy. So commentators on this have put the odds of approval down from 80-20 to 50-50, and I think that's what it is. But it is, clearly a decision on by somebody who has support on the issue and somebody who is concerned about greenhouse gas emissions. It may not be the most sensible way of going about it from a rational perspective. If the target is production of gas out of oil sands, it's likely not to have an impact, but likely just to delay development until those other pipelines get built. But I have no other comments to put on that one. Yeah.
You've devoted most of your talk to oil and gas. I wonder if you could talk a little bit about the impact on oil and gas, longer term, of investments, either private sector, public sector investments in renewables, energy efficiency. So what about wind, what about solar, geothermal, biomass, and perhaps nuclear as well?
Yeah. On first blush, you would think that new sources of supply, particularly if they become increasingly price competitive, would be pushing out renewables. And that's not actually a logical conclusion. It could, but it wouldn't have to. Just looking at cost curves, and I'm happy to send you what I'm talking about. If you trace the efficiency gains in the two most important areas from a global perspective of renewables, namely wind and solar photovoltaic, there is no doubt that what were once prohibitive in terms of costs are becoming less prohibitive, and in the case of wind, very competitive against fossil fuels, and against all the fossil fuels, so oil, gas, and coal. The major impediment on the use of the renewables is the nature of the sector where they're being targeted and the nature of regulation in the sector where they're being targeted. So I'd say that by definition, they're interruptible sources of supply. What's missing in terms of full baseload introduction to interruptible sources of supply is battery power and computer smart grid technology. So there had been great hope that large-scale battery technology would be emerging. The U.S. government is a massive investor in battery technology. Publicly, the largest investor is the U.S. Energy Department, but actually the largest investor is the Pentagon because of the logistics of a military that has boots on the ground in 100 countries, and the need for non-interruptible energy, which puts an emphasis on breakthrough technologies, disruptive change technologies on battery side. That has not happened, but what's happened is software technology is making really large breakthroughs, and the software technology can husband the renewables as stored and use them, inject them into the grid in a way that maximizes their potential on an hourly and daily basis. So you can get to the point where both wind and solar combined in a large part of the world can push out a significant amount of base load. That significant amount could be in, average, whatever that means, North American place. 60% of power could be generated by renewables. On a pure technology basis, wind is fully competitive, solar is not fully competitive, but the rate of growth of efficiency on the solar side means that solar is competitive within a few years, certainly by the end of this decade. So that's not very long from now. The next part of it is regulatory. Growth in power requirements in North America have slowed down to a trickle. You could call OECD electricity demand as stagnant. And there's a problem with the utility model in all of our cultures and economies, because the utility models were based on increased supply and sharing the load growth. So here you have a utility that may, by regulation and by economics, move toward a very large-scale baseload supply of renewables, but they need the non-interruptible supply as well. So they need the fossil fuels in storage for the times when the interruptible supply is not available, which is costly, and that creates a regulatory nightmare when the utility model is being challenged because, A, as I said, power growth in terms of demand has stagnated, and B, we have this phenomenon of distributed energy because a lot of the renewables are not on-grid renewables but off-grid. They're done by companies that put in their own wind power, their own solar panels, and move off-grid, making the challenge for the utilities even greater. So I'd say that it's moving away from being something challenged by new supply that's lower cost, something that is moving away from requiring subsidies to being fully competitive, but the utility model is the big challenge, and there may be a breakthrough in battery technology, but it doesn't look like it's imminent.